Good morning. My name is David, and I'm coming to you live from your computer screen or mobile phone. On Drudge Report today, which is a somewhat conservative-leaning news aggregator, there's articles on the rate cut being off because of employment jumping, and this is good news for me because I don't believe that we should have a rate cut. I think rates should stay. We should try to keep them at some sort of normal higher level as long as possible until we actually have a crisis that we need to cut for. And the economy is going well enough, in my point of view, that we don't need a rate cut right now, regardless of some small number this way or that way. But if some small number this way or that way will convince the government to do my policy, then that's great. So happy to hear that there may not be a rate cut. And as I'm reading that, I'm reading comments on my StockTwits here. Let's see, E-Trade. People talking about rates. Yeah, rates is a tough thing with trading. You really have to kind of fight these brokerages for better rates, and it's not really their fault. It's a tough environment for all the brokerages out there because there's a ton of competition. They can't charge what they used to, back in the day when it was like, only rich people with suits actually traded stuff, and you had to call your broker and it cost you like $150 to buy 100 shares. They're used to that, and the world has changed a lot. And actually, payment for order flow came in a while ago, and what that was is that instead of actually charging people, there were actually companies out there that were willing to pay people to trade just to get that order flow, get that volume. And nowadays it's back and forth between the major brokerages are getting paid for their order flow, and then they're turning around and charging you. So, if they charge you even a small amount, they're still making money on both sides. They're making money on the side of selling their order flow, and they're making money on the side of charging you rate. So don't feel guilty at all about trying to hold these people's feet to the fire. I'm happy with TD Ameritrade. I did leave them and say I'll only come back if you lower my rates, and they said they would lower my rates, and so I did come back to them because I do want to honor what I say. But I would recommend, if you're trading, to have more than one brokerage set up. That way, if you get in a little, if you get in a little fight with one of them, you can jump to another one. That sort of thing. Also, if you are a smaller trader and you're dealing with pattern day trade rules, which is basically you need 25 grand in your account to do more than 3 round trips in a 5-day period, then it can be beneficial to have more than one brokerage, because if for some reason you mess it up and get locked out for 90 days, you don't have to wait weeks and weeks and weeks to trade again or to set up a new brokerage account. So I would recommend having more than one brokerage. But anyways, let's get back on target here. The jobs number came out, rates cut off, possibly, and market down. There is an opportunity here, though, for us UVXY traders, because UVXY is up like $2 with the market down. So if you did want to jump on the short vol thing, now might be a time. I don't necessarily agree with the analysis today. The market goes down, and then all the media tries to say why it went down, and they look at it in the very short term. I think it definitely could continue to go lower from here. We are at the highs right now, so I think maybe the jobs report was just a catalyst to start the move, but we definitely could, volatility could pop from here farther. It's, I wouldn't necessarily, I've had it several times where the thing spiked and I held off for the first little move of the spike, and then I laid into a short, and it just continued to spike a lot farther from that initial pop. So, you know, you don't necessarily want to lay into this initial pop, but I would, you know, if you're looking to short volatility, I would either maybe consider selling a teeny bit or at least monitor the situation from here, because we are off the complete lows, but we're still low. I mean, let's look at the VIX here for a second. And you're going to see that VIX back up to 1420. So that's higher than it has been in the last few days, but still not super duper high. You can see we're still way down here on the chart. So a little pop here. Nobody knows where it's gonna go from here, but definitely of note. BYND. You know, I almost didn't come on today because this is something about traders that we don't talk about all that much, but I'm superstitious, and you know, whichever way you tend to characterize it, trading has luck involved in it, and it's better to be lucky than good, and you need a little luck on your side in life anywhere, but even more so in trading to make it. And my position in BYND has been going really well the last few sessions, and I don't want to somehow ruin my luck. It seems to be working perfect right now, and I'm almost hesitant to come on because I don't want it to go sideways on me. But if you look at BYND, my position now is I'm just short a bunch of options and looking for it to just kind of stay where it is. And it has done so perfectly in the last few sessions. I mean, if we look here, at the chart, look, it was all over the board, and all of a sudden it just kind of stopped right here on the 1st of July. And granted, there's been a day off and stuff, but now we're on the 5th of July, and it really hasn't moved at all. I mean, it is, you know, the 1st of July it was trading around 52.65. Now it's trading, it traded up to 53 and down to 48. So it's just hanging out, doing absolutely nothing. My positions right now, I'll show you on BYND, is essentially I am short the 110, 185 strangle. So I need it to just stay between 110 and 185, and it's doing that perfectly right now. Now, things don't usually last for very long, and this probably won't last for very long, but right now this position is working out great, and so that's awesome. I had some other ideas that I was working on. I put a trade on in Tesla before the break on the 3rd here. Now, Tesla has really rebounded very nicely from the lows of, what was it, like 178, 176, 176.99 back in May 30th. It's rebounded all the way up to 240. Now it's 231. And if you go back a few months, I was talking a lot about calendar spreads, and I was looking at a calendar spread on this one. Now, I like to use calendar spreads and put the strike right where I'm predicting the stock is going to go to and end up at. And with this one, I was thinking, wow, you know, this probably is going to keep rallying a little bit more. So I was looking at the 260 strike in Tesla and looking to put a calendar spread on, and I actually did put a calendar spread on. And I bought the August 260 call and sold the July 260 call. And I was putting the spread on for like $5. Now, usually what's going to happen with one of these spreads is that the front month is going to decay a lot faster than the back month. And so you're selling the closer month and buying the back one. And if you stay near that strike, the front month is going to decay a lot faster. And all of a sudden, you're going to own a back month call, and the front month is paying for it. That's kind of the way it works. But these spreads, especially calendar spreads, they can move all over the place. And so if you put one on, you can find it kind of go against you a little bit, or go your way a little bit, and it can sometimes not sort of make sense. And so if you just hang around, it can go against you and go your way a lot. So when I put one of these on, I can find the next day having like a huge profit sometimes. And if that happens, I just bounce out of it. And that's kind of what happened with this one. I put it on, it showed a decent profit like the next session, and so I just took it right off. I had another stock this year that I did that in. Let me see if I can find it here. And it was just one of these things where like I put a trade on, then the next day it made me a few $100s sort of out of nowhere, and then I was just like, all right, I'm just taking it off. Forget it. And let me see if I can figure out how to find a list of everything. It is eluding me for the time being here. Account statement. It is eluding. Oh, here we go. All right, so this is all the different products I traded this year. ACB, Amazon, Boeing, Beyond, COUP, et cetera, et cetera, et cetera. And this Ross Stores is the one. I put the spread on. I made $580 in like 2 sessions, and I just took it off because it was one of those calendars. But with calendars, once again, it's an interesting trade because you aren't risking all that much on them. You're risking what you pay for the calendar, and in a lot of cases, that can go a lot higher. We talk about calendar spreads a lot when we're dealing with earnings situation where like the front months are jacked. If you have a stock that there's a lot of excitement about, or there's some sort of big product announcement or something, and earnings are about to come out, you can find the front months are just jacked up to the moon. And a lot of times they're not going to take the back months up in price because they know that as soon as this binary event is over, it's going right back down. And that's a great time to put a calendar spread on, because when things come back into orbit, you're a winner. Because you sold the really high price stuff and you bought the cheaper stuff against it. Now, if you were just selling the really high price stuff, then you leave yourself open to like a gap move. But when you're buying something against it and turning it into a calendar spread, you don't have as much risk as you still aren't going to do as well if there's a gap move one way or another, but you have a lot less risk. And a lot of times when you've got a front month that's really, really high and a farther month that's low, you're going to spend, these calendar spreads are going to be dollar cheap. It could be like the best winner I had this year was ICPT. In normal pricing, this calendar spread would have been worth like $5, but because the front month was so jacked, it was only trading for like $2. And when it went back to $5-6, I was able to double my money. So calendar spreads are interesting, and it's something you might just want to try out. And the way to do it, once again, is you can pick, let's just use Tesla for example. You want to pick a strike where you think it's likely that the stock's going to end up at. So right now Tesla's 232. What if we pick like the 240 strike? And now Tesla right now, if we look, let me move out of the way one more time here. So if you look just to my right here, you're going to see the volatility of different months. And it's actually reverse of what you really want to do for a calendar spread. The front months are cheaper in this case, and the farther out months are more expensive. And this due to, I believe this is just due to like summer boredom type stuff. And then the earnings month is a little bit higher. When you get to like sort of the dog days of summer, and we're not there yet, but when you get to the dog days of summer, people start thinking historically about, the market crashed in October. The big, big crashes. The 87 crash was in October, and people start to think, wow, October is dangerous, and it's all. I guess it's part of it is that like the summer will be over, and the beautiful weather is going to be over, and all of this psychology goes into people being fearful of like October. And so a lot of times you'll see October volatility a little higher than other ones, or just because of historically of that crash, which rationally thinking doesn't make a whole lot of sense really. But that's the way it works sometimes. All right, so if we look although the pricing doesn't line up for this to be a good do, let's just look at this mechanically. So we might buy maybe the September 240 call. So I'm going to go on my Thinkorswim here, and I'm going to click on the offer of the September 240 call. It's going to bring up those order screen. And then I can go back to maybe like July. And I can I can hold down Control and click on the bid of the July 240 call. And that gets our spread going. So $13.75 for the spread. Now that's $1,300 each time you do this. And, that's ultimately what you could lose, although it would be pretty difficult for this 240 call in Tesla to go to zero, even if, the spread to go to zero, even if it moved very far away from 240. So it's kind of like buying Apple and just buying the stock. Most of that money that you have in the stock, the likelihood of Apple going below 50%, going down over 50% is so small that it really isn't something you need to worry about. And it's the same thing with the spread. Like, yes, you're paying $1,300 for each spread, but for this spread to cut in half would take an extraordinary move in Tesla. So you could think of it as maybe what you're really risking is about a third of this price, which is still significant depending on how many spreads you buy. But this would be kind of an example of one of these spreads. So let's pull this into our analysis tab, and I'm going to make sure there's nothing else in Tesla. And let's just say we did this spread 10 times just to give us some numbers here, or let's say 20 times. So doing this spread 20 times, it's going to show us long delta. Now that makes sense because Tesla is 232 now, and this is a 240 strike spread. So you're going to be long deltas when the stock is below the price of the strike price, and you're going to be short deltas when the stock is above the strike price. So that just reflects that we'd ultimately like this to go right to the strike when we put a calendar spread on. So you're going to be long delta. You're going to make money as it goes up towards the strike. And then once you're above the strike, you're going to make money as it goes down, back down to the strike. So, and if we did this 20 times, we'd be collecting $273 a day. Now remember, regardless of what the volatility differential is between these options, the front month is going to decay faster than the back month, and thus, as long as Tesla stays near this strike, this spread is going to make you money because the front month is always going to decay faster than the back month. However, you're going to do better if there is a differential between the front and back month, where the front month is a higher volatility. I want to do start doing some classes just for people on just very basic option strategy. I know there are a lot of traders out there who have been very successful at trading stocks or ETFs, but they just have never dipped their toe into the options world. And there are a lot of people out there that are actually like that, and they are very talented traders. They just have not, as of yet, gotten into options. And maybe it's that they've heard bad things about the spread. Maybe they've heard of people getting burned. But, it would behoove you, if you haven't jumped into the options world yet, to check it out, because it's like any other thing you study in school. When you haven't taken the class yet, it seems mystifying, and it might seem like it doesn't make sense, or that like someone's ripping you off. But once you study the theory behind it and you understand stuff, then you have that, you're armed with that knowledge, and nobody's going to rip you off. The only way someone can rip you off, quote unquote, on options is if you let them, if you pay a price that is not reasonable for something. And if you can start to work on understanding pricing, then no one's going to rip you off, because the knowledge is out there, and everybody has access to the same knowledge. It's the same theory for everybody. And so, yeah, I'm considering just doing a basic options class, just talking about starting with buying calls and what are the risks, and how is buying a call better than buying a stock, and how is it different? Because options are more precise than trading stock. It's kind of like, I don't want to use checkers versus chess, because those are two completely different games, but it's like using a butter knife versus using a scalpel. How about that? To cut with. Options, you can just be much more precise, and you can make much more detailed bets. Instead of just betting, I think this is going to go up, or I think this is going to go down, you could say, I think Tesla is going to stay within the range of 200 to 260 in the next 3 months. Or I think Tesla is definitely going to move higher than 230, but it's not moving higher than 300. Or I think Tesla's going to sit still for the next 6 weeks, but as soon as earnings come, it's going to explode one way or the other. These are the kind of bets you can place with options, whereas stock is just up or down. And this is one of the reasons why, like, Forex to me is so confusing, because you're just betting up or down, and it's a relationship between two foreign currencies, and there's so many things in the world that go into the relationship between two different currencies that are hard to quantify, and it's so hard to say how much this or that is going to affect that relationship compared with all the other things in the world that would affect that relationship. That's why Forex to me is mystifying, so I stay away from it. All right, so it looks like we're coming back a little bit in the market here. It's hard to say if this is going to be like, here's the pop, here's the only chance to get into a short in volatility, or if this is just the beginning of something bigger. Let's take a look at VIX Central for a second and get a little update on contango. And contango at 7%. Contango has been consistently above 5% for weeks now, and that bodes well for us being short. For those of us short volatility. Even though I have the short vol show, I'm not currently short volatility. They make fun of me when I come on Volatility Views, because they say, oh, you must always be short volatility if that's the name of the show. But I am not. But that doesn't mean that you can't be, and it doesn't mean that it's not a good time to be. And if you were looking to get short a week ago, here's your chance, because we got a pop here. UVXY up 135. It was up almost 2 at one point, I think. Let's pull up UVXY really quickly here and take a look. And that chart doesn't look very appealing to short something, does it? I mean, it's gone straight down. Well, I don't know. It depends on the way you look at it, I suppose. Here's UVXY, the big pop, and then kind of the fade here. And we'll see if it continues to fade back down. But wow, what a pop there. I did have a position where I had bought these December 28 calls, which I got out of. This would have been a great chance. If I was still long them, this would be a great chance to sell something against them. As we got this big move up, and I can just see like new people being like, wow, it's on, here we go, here's the spike, and like buying it like right here, 28.86. I could just see that happening. When you're thinking about buying or selling stuff, it can be very good to check different time periods on these charts. Like, back it out and try to think of stuff in a broader context than just what's happening today, because guess what? After today comes tomorrow, and the next day, and the next day, and the next day. And having a wider perspective is really important. They say that like the smarter people in the world are planning farther out in time. Like their actions today reflect what they want to happen 3 years from now, whereas a lot of people who aren't as organized, let's say, are just thinking about what's going to happen today, what's going to happen tomorrow. Start planning farther out, especially with options trading. You know, I'm a position trader that trades over a time period. You need to think of things in a longer horizon, because that's how you can build something, is over a longer period of time. So this really right here, this chart really defines I think what's happening with vol right this second. Let me just kind of move a little bit here, but look at this chart to my left. This kind of defines today. You know, we've had this big down move, and then we've got this little pop today. And is that the start of something else, or does this down move just continue? It seems like right now the down move is just going to continue. As E-minis kind of recover a teeny bit. What a weird world we're in, where good news for like the jobs report and stuff, you know, you get some good economic news and the stock market sells off. Because the stock market wants that short-term rate cut just to goose it. It wants that, you know, it wants that rush of adrenaline from a rate cut, and good news means they might not get that rate cut. Now, I think that's good for the stock market, because it means that we can continue to grow without having to goose interest rates. But, you know, the market acting short term is like, no, oh no, good news means we won't get the rate cut, so let's sell off. It's so bizarre. All right. Thanks for watching, and enjoy your weekend. I hope you had a good 4th of July. And it's like holiday, and then one day, and then we get a weekend again. So, you know, although it's not the summer doldrums yet, this particular period feels like doldrums, because if you're long options right now, you know, you get like one day to work with, and then you got to wait. And then, you know, you got earlier in the week, you got a couple days to work with, then you got to wait. Then you got one day, now you got to wait 2 more days again. And it's like, it can be sort of painful. I'm sure that stuff will be popped up and back into action on Monday morning. But until then, we have just the rest of this session today and then the weekend. So let me know what you're thinking about. Let's check the chat just for a second here before we go. And I'm going to have to mute this here. Then you got to wait. There we go. Hi, Marcella. Man, accounts 25 still on the table. Yeah, I mean, this could just be a pop, and then boom, it's over again, and we're right back down. Bad luck to be superstitious. Well, one of the things that was big on the trading floor was like never write with a red pen, because you write with a red pen, and that means that you're going to be in the red. I'm not overly superstitious, but you know, there are a lot of traders who will not talk about their positions until they're closed, and I kind of get that. You don't want to tempt fate. You don't want to tempt the trading gods, and certainly you don't want to brag about making money, because that's the quickest way to have the trading gods' wrath against you. You come onto StockTwits and be like, "I'm so smart, I made so much money," or "I'm gonna make so much money." That is totally asking for trouble, and you might think that that's just a bunch of hooey, but it's not. All right, folks. Well, thanks for watching, and I will see you probably Monday morning. Enjoy the rest of the trading day, and enjoy your weekend, and thanks for watching.